A mysterious currency with an even more mysterious founder that's making some people very rich. That's Bitcoin for you. Unlike the rupee, dollar, pound or euro, it's not printed by a central bank and you can't hold it in your hand. And that's why senior broking fellow Eswar Prasad is convinced that the virtual currency is going to be a force to reckon with. In his latest paper, Stock Taking and Preliminary Thought, Prasad argues that tech is changing traditional banking practices. Let's step back and take a look at the existing form of currencies. Fiat currency, better known as bank notes. These are issued by the central banks and still the most commonly used form of currency in most parts of the world. E-money, the money that exists in banking computer systems and available for transactions through electronic systems. The value of e-money is backed by fiat currency and can be easily exchanged into physical form. The digital currency that's taken the internet space by storm. It offers the anonymity of cash, but a currency which is not printed by the government. Let's delve a little deeper. What exactly led to the surge of bitcoins then, and why do they have any value at all? Well, for one, banks and other financial authorities have no way to interrupt transactions or place freezes on Bitcoin accounts. Second, the deals are not subjected to any taxation and the transaction costs are pretty low compared to traditional methods of currency exchange. Third, and most importantly, cryptocurrency transactions are anonymous. That is, unless a user voluntarily publishes his Bitcoin transactions, his purchases are never associated with his personal identity. And lastly, central banks lightly ammo against cryptocurrencies, government's own virtual currency. While few countries like Venezuela and the Marshall Islands have already embraced the new age cryptocurrencies, most of the higher economies are still less forthcoming on plans to introduce their version of cryptocurrencies. The benefits of official cryptocurrencies are plenty. They bring down the costs of transactions and infuse competitiveness among the various payment systems. But technological challenges and impact on monetary policy transmission are some of the hindrances that central banks are looking into. So as things stand, digital currency is a big disruptive force, yes, but will it replace the good old government-backed currencies? The answer for now is a resounding no.
Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, however, rather than look at developments in the macroeconomic arena, I'm going to try and take a peep into the future of central banking in a digital age, with none other than Eswar Prasad, Professor Economics at Cornell and also Senior Fellow, Brookings Institution, Washington, who has just brought out a paper on the subject. Thank you, Eswar, for joining us at ET Now to discuss something that at the moment has a whiff of the unreal in the staid world of central banking. So let me plunge into the discussion right away. You call your paper Central Banking in the Digital Age, Stock Taking and Preliminary Thoughts, presumably because it's very early days yet and digital currency is itself in its infancy. Nonetheless, you've raised a number of very important issues regarding the implications of these developments for the financial sector. What does the proliferation of such currencies mean for the functioning of traditional banks? How will they affect the operation of central banks and monetary policy? In particular, their ability to deliver on key objectives such as low inflation and financial stability and so on. It also comes at a very opportune moment because the Reserve Bank of India has recently set up a committee to examine whether it should issue digital currency. Given its earlier suspicion of digital currency and indeed its virtual ban, thanks to its diktat that regulated entities should not deal in virtual currency, its about turn is a bit surprising. Maybe it could take note of some of the key points that you've raised in your paper, and for the benefit of our viewers, I'd like to draw you into discussion on each of these in some detail. But before I do that, let me ask you, where do you stand on digital currencies? Do you see them as a net positive or a net negative? We'll come to the pros and cons a little later in the discussion, but what would your broad brush answer be?
That depends to some extent on what the central bank and the government more generally does. Now, of course, when talking about digital currencies, it's important to make a distinction between non-official cryptocurrencies such as Bitcoin and central bank digital currencies. What the Reserve Bank of India is thinking of doing right now is setting up a digital version of the Indian rupee. This is something many other central banks are considering doing as well. And at some level, it certainly makes sense because the use of physical cash is certainly not that efficient. It can be used for illicit activities. It makes it much harder to trace, and it also makes it somewhat harder for the Reserve Bank of India to implement monetary policy in certain dimensions. So using central bank digital currency certainly has some virtues to it. It allows the central bank to maintain, in effect, a retail payment system. It allows the central bank to control illegitimate activities, and in some sense reduces the shadow economy and therefore widens the tax base as well. So there are certainly many positives to it. Certainly, central bank digital currencies may not have the anonymity that cash now provides, and whether that's a net positive or negative is for a society to decide at a political rather than an economic level.
You spoke of the many benefits of shifting from physical to digital currency. What are these benefits? Also, given that in a country like India, access to the digital world is limited to a very minuscule section of the population, will it not further increase the divide between the haves and the have-nots? Could cryptocurrencies backed by physical currency be a via media?
It is certainly true that setting up a digital version of a national currency without having people connected in some way electronically to the network is going to be a bit of a problem. Certainly in many rural parts of India where internet connectivity is very poor and even mobile banking is only now beginning to have an impact, it would be a little difficult to make an immediate transition to a central bank digital currency. But certainly one can think about central bank digital currency as providing an impetus for greater connectivity to the financial system. So if the government were to push forward measures to improve internet connectivity, this could actually go hand in hand. But in any case, I think what is more realistic is probably a situation where both the digital and physical versions of the central bank currency exist side by side, while the payment systems, while the electronic systems and the connectivity catch up, and eventually we move towards a central bank digital currency. Right now, there are just a couple of economies in the world, Tunisia and Senegal, that have purely electronic versions of their fiat currencies. Some countries like Sweden are moving towards it, but even in very advanced economies such as the US and Europe, cash still plays a fairly important role. So cash in physical form is not in danger of disappearing anytime soon, but in a developing country like India, certainly it can play a useful role in terms of reducing the size of the shadow economy and bringing more economic activity into the more formal economic fold.
But if both kinds of currency are going to exist side by side, won't that further complicate the issue of monetary policy and its transmission in particular?
I don't think by itself it will matter, and ultimately when one thinks about monetary policy, it's worth remembering that central bank issued money is only a very small part of what one might think of as broader monetary aggregates. So there is this monetary aggregate called M2 that people use as a very important indicator of how much credit there is in the economy. But M2 is made of both central bank issued currency but also money created by banks, which make loans and thereby create deposits as well that correspond with those loans. So a lot of money is really created by the banking system rather than by the central bank. So what I think is even more interesting to observe, which I point out in the report that you alluded to, is how these new technologies that underpin cryptocurrencies are going to affect the world of finance and banking more in particular. Central bank issued digital currencies by themselves are going to be a small part of the aggregate money supply, but they could actually in some ways make it easier to implement monetary policy. If all of us had electronic wallets with the central bank, it would be a lot easier for the central bank to either increase or decrease the size of those electronic wallets. So in some sense, the constraints about not being able to push interest rates below zero, a constraint that many advanced economies faced in the immediate aftermath of the global financial crisis, that sort of disappears if the central bank can essentially reduce balances in those electronic wallets. Or if the government needs to make an infusion of cash, it can basically put money in a non-distortionary way into all of those electronic wallets. So at some level, it could make monetary policy implementation somewhat easier. But the big unknown is what is going to happen to the financial system and how the transmission of monetary policy through the banks and other parts of the financial system is changed by these digital currencies. And there we still don't have a good sense.
Yes, Ishwar, you've taken us far back in time, but those were times when volumes were much less than today, whereas today what we're seeing is a surge in volumes. And that brings me to my next question. How will digital currencies affect traditional banks? Yes, we now have alternate channels like Alibaba that can use big data and hence have as much knowledge about their users as traditional banks, and hence also have credit scores, etc. But will they inspire the same confidence as banks that have the implicit banking of governments and are seen as too big to fail? Does it pose a risk to the future of banks as we know them today?
The good thing from the point of view of consumers and about the financial system is I think financial transactions are going to become cheaper, more efficient, and much quicker, which is certainly going to be a net positive for consumers and for the economy. But at the same time, it is going to have an impact on the financial system because banks in particular benefit from the many inefficiencies in the financial system that now exist. It takes a fairly long time. It is quite costly for payments to be transacted through the financial system. It is not always straightforward to get immediate verification that is necessary for settlement purposes. All of this is going to be a lot easier with this blockchain technology that underpins Bitcoin and other cryptocurrencies. The technology is not fully mature yet, but it is certainly making very good progress. So all of this is going to be positive, but it certainly means that the margins that banks and other financial institutions have been making because of these inefficiencies, those are going to disappear. So it's going to put a crimp on banking institutions' profits. But at the same time, there are new financial institutions emerging. You talked about Alibaba and Alipay in China, which have made payments, including micro payments, much more efficient, much quicker, and much less expensive. So that, I think, is the wave of the future. But it is going to mean that banks are going to have to reform their business models. They will still play a very important role in terms of financial intermediation. But certainly the profit margins that they were getting by exploiting the inefficiencies in the financial system, those they cannot count on for much longer.
But will it not make the job of banking supervision even more difficult than it is today?
Central banks and regulatory authorities face enormous challenges because, first of all, we have new financial players with new business models, and exactly how to regulate them while at the same time not stifling innovation is a very important challenge. One can see a lot of new payment systems arising which are not centralized, which are not backed by the government, and these private payment systems and settlement systems could turn out to be much more efficient, could turn out to be much less expensive, but the problem is that they don't have government backing and therefore don't have trust. So in good times they may function very well and lead to greater efficiency in the financial system, but at a moment of financial stress or some sort of panic, then one could very well conceive of a scenario where trust in those decentralized, that is private payment systems, evaporates very quickly. So if there isn't an alternative, a government-backed or central bank-backed payment systems, that could lead to financial and economic chaos. At the same time, the fact that banks are going to be facing enormous challenges, and that's where a lot of the regulatory authorities tend to focus on, is going to create some challenges because if we lose banks and they still play a very important role in financial intermediation, that could affect economic activity as well. So regulatory authorities are going to have to be quite open-minded about the new technologies, quite flexible about allowing them to flourish, but at the same time making sure that these new technologies don't get ahead of the regulation. Many countries are providing what are called regulatory sandboxes where these innovations can take place in a controlled environment before they can be scaled up. And I suspect that that's where we will see some of these experiments coming to pass, and I hope the regulatory authorities will learn enough from those experiments to be able to ensure financial stability without hurting innovation.
Let me interrupt you there for a moment, Ishwar, because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Eswar Prasad on the implications of digital currency for the future of central banking in particular. Eswar, yes, it's always a challenge for the supervisor and the regulator to stay ahead of the regulated. So can we really afford a proliferation of currencies and payment systems that don't have official backing? You spoke of the danger of financial chaos, and your paper points out that there are now about 1400 cryptocurrencies, and I'm sure this is only the beginning. So I must confess I'm a bit foxed, because one of the basic prerequisites of a currency is widespread acceptability as a medium of exchange. In fact, that's what makes it legal tender. But cryptocurrencies don't have widespread acceptance. So can we even include them as currencies as we understand the term?
This is a very interesting and open question, and in fact goes back to monetary debates that have existed for hundreds of years. In fact, in some of my research, I found similar debates in the Confucian era in China in 100 to 200 BC, where there was a discussion about whether it was better for a government to issue a currency, at the time it was the emperor, or to have private currencies circulating, because then the issuers of those private currencies, because of competition and the need to maintain the value of their currencies, would make sure that their currencies were not debased. At some level, it doesn't necessarily lead to more financial instability if you have private currencies circulating in tandem with fiat currencies. But I think ultimately it's going to come down to trust. Right now, there is a sense that cryptocurrencies are trying to displace trust that exists in central banks around the world through better verification mechanisms, because what the central bank ultimately provides is verification by a government authority that is trusted. The idea of something like Bitcoin is that this verification is done by people power, because you have a decentralized verification mechanism whereby everybody in the network has to agree on a particular transaction and verify it. I don't think ultimately that this trust that exists in central banks and other official institutions can be superseded by these cryptocurrencies, but it is going to be interesting to see how they evolve and how they compete with each other eventually.
Has the confidence in cryptocurrencies been dented by the sharp fall in the value of bitcoins? We've seen values collapse from where they were a year ago, and many who were counting on making a killing have in fact burnt their fingers.
Right now, it seems like cryptocurrencies such as Bitcoin are being held up by something of a speculative bubble because they don't have intrinsic value, and the one thing that seems to be holding up Bitcoin's value is the sense that there is a scarcity aspect to it, because the algorithm is set up such that there are ultimately going to be only 21 million Bitcoins mined. But the fact that there is no intrinsic value to these cryptocurrencies, and they don't seem to be working very well as mediums of exchange because of the congestion in the network and the price of transacting using Bitcoin, suggests that we might be in the middle of a speculative frenzy. So it could go either way. In the next 5 years, we might see the price of Bitcoin either going to zero or to some astronomical amount, but it is hard to envision, at least for me as an economist, how we could have these sorts of valuations for a store of value that is not backed by a government or the taxing authority of a government and is simply being borne along by a speculative frenzy.
You point to the possible repercussions on international capital flows and exchange rates, and these are both issues that are of special relevance to emerging market economies, even to countries like India that don't have full capital account convertibility. So can we afford a possible increase in vulnerability? We're already seeing early signs of the kind of damage a reversal in capital flows can do.
For emerging market economies, the emergence of the technology underlying cryptocurrencies is certainly going to be a challenge. Again, there are positive elements here. Right now, international transfers of money, for instance, remittances of Indian workers who may be sending money back to India, is extremely slow, costly and inefficient. There are new technologies coming in place that this transfer can be undertaken very quickly with immediate verification of the settlement and at a very low cost. But the technology also implies that capital is going to be much more easy to move across national borders. So the reality that emerging markets such as India will face is that capital is going to become much more easy to move across borders. So national borders are going to become very porous in terms of capital flows, which is going to make it somewhat harder to manage capital flows as well as exchange rates. So the fact that exchange rate volatility might in fact increase because of these volatile capital flows as international investors can more easily shift their portfolios around relatively inexpensively is going to lead some challenges. So what is ultimately going to be crucial to deal with this is to have broader and deeper financial markets and an economy that can more easily withstand exchange rate volatility and capital flow volatility. But that might be the harsh reality that emerging markets face. But again, one should acknowledge that there are benefits to be had as well.
Eswar, you say that the efficiency gains in normal times from having decentralized payment and settlement systems needs to be balanced against their potential technical vulnerabilities and the repercussions of loss of confidence during periods of financial stress. Given the increasing number of instances of cyber attacks, net, where do you think the benefit lies?
There are certainly big concerns about the technology. First of all, as I mentioned, even with something like Bitcoin, there is so much congestion in the network right now that the costs of transacting using Bitcoin have risen a lot. In addition, these networks are very vulnerable to hacking. We've had a number of hacks of Bitcoin exchanges as well as other cryptocurrency exchanges. But on net, again, the blockchain technology does seem to have the potential to be able to affect finance, but also broader applications, including commercial contracts, because what it does provide is a very decentralized way and a very efficient way of providing verification of contract settlement and of various commercial transactions, not just financial ones. So I think the technology, which is being increasingly adopted in many areas in finance and elsewhere, does have the transformative potential. It's not quite mature yet, but once many of the kinks can be worked out, I think the sense that this is a technology that could really make a big difference in terms of improving efficiency, reducing costs, and allowing for finality of settlement, which is very important in financial transactions. Those propositions, I think, are still very true and relevant.
Well, one of the attractions of cryptocurrency is really its anonymity. But do we want anonymity in a world where terror financing is a matter of huge concern both to governments and citizens, and both would like to know the money trail?
That is certainly a very legitimate concern about non-official cryptocurrencies. So at one level, one might view the desire of certain central banks to look into issuing their own digital currencies as a way around allowing non-official cryptocurrencies to sort of rule the electronic domain. So if the verification is provided by a centralized authority such as a government, it certainly reduces the potential for electronic currencies to be used for illicit purposes. One might argue that we live in a world right now where we are ceding many elements of our privacy, and I certainly would feel somewhat uncomfortable with the government knowing about all of my transactions. Not that I have any legitimate transactions, but certainly I do value my privacy. So this is again something that is not so much economic, but which needs to be decided as a societal level. Sweden, for instance, is having very active debates right now about precisely this issue, about whether its people want the central bank to know about all their transactions. But from a different societal point of view, certainly there is a great value to reducing illicit activities and putting a crimp on such illicit activities by reducing their financing through physical cash. So I think on net it may turn out to be a positive, but certainly in the long run there are some very important questions that we as societies are going to face about how much privacy we are willing to give up in order to gain these benefits.
It's been fascinating speaking with you, Eswar. Thank you so much for taking time out from your busy schedule to share your views with our viewers on how technology, in particular the advent of decentralized cryptocurrencies like Bitcoin, is going to change the world of finance and central banks. In a world where the masters of the universe like Janet Yellen, former chair of the US Federal Reserve, confess that we don't understand enough about what drives inflation anymore, the advent of cryptocurrencies is going to make the job of central bankers incredibly difficult. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at TT Now.